Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 19th of December, 2025. Waking up this morning is a little bit better than the previous 4 days for the US. Stocks were higher on weakening inflation, 2.6%. The bad news is the numbers are, doctored would be the nicest and politest way to put it, but there was a large number of omissions for particularly inflationary parts of the data and a very clear focus on the disinflationary parts. I'll cover it in a little bit more detail soon. That's essentially put expectations of Federal Reserve rate cuts in January. I would be very cautious because they can be taken away pretty quickly. The 2-year yields overnight basically didn't really reflect that at all, to be honest. In the treasuries in the US, so I'd just be very careful using this as your yardstick for stocks obviously bottoming and going higher, and whether this is the dip or not. Aussie basically flat. Pretty much everything's nearly flat for the week. Except in Asia, Euro stocks got back up 1% overnight, but pretty much flat for the week. The Nikkei is down, but it's doing its own thing. The Nikkei generally does kind of do its own thing. There's a Bank of Japan meeting today, and I would imagine there may be some movement out of that. Really conflicting signals coming out of Japan. New female governor, supposed to be super loose on monetary policy, and then they're talking rate hikes, and their long end bond yields are going through the roof because people want more premium to be to hold their debt, because they are. You think the US is debt laden. Japan's the worst debt to GDP in the world by a long margin. So, the Dow essentially was flat. The S&P was up 0.8. NASDAQ up 1.5. Russell up 0.7. The technicals didn't really turn too much, I've got to say. And if anything, they probably consolidated in the sell signals. There was weakness into the death. We were up about 1.8. In the NASDAQ at one stage, Micron very much helping that. So we had they had a great earnings result last night, or yesterday morning, sorry, and we really did have it was a nice sort of memory chip led bounce back in those stocks overall. So I'll just get to the heat map here in a minute, and because we've unfortunately got a bit of an old one there, and but moving on to these these inflation numbers, realistically, the fact that people have been able to pick holes in these numbers straight away, and Trump came out commenting on it straight away about how inflation was down. Put two and two together, it's fairly well planned. So as you can see there, Micron up 10%, NVIDIA recovered 1.8, Google and Microsoft 1.9, 1.6, Meta 2. So really just led higher by, your mega cap stocks overall. There wasn't a huge amount of movement, I guess, in most of the other sectors. The oil sector came back a little bit. I think there was some speculative buying because of that Venezuela blockade yesterday. Starbucks had a reasonable run up at 5%. And we also had FedEx earnings. It's up slightly in the aftermarket, and Nike earnings as well, which were fairly muted. And you would think that everyone was talking about them previously, or into the numbers, and saying they're going to be a huge bellwether of the economy. But they've obviously found something pretty horrible in the Nike results, because it's down 8% over 9% actually now in the aftermarket. And FedEx is, if you just bear with me 1 second, FedEx is up well, up 1.7 in the day session and up 2% after hours. So their focus on B2B deliveries is where they've made some efficiency gains, and they're pretty upbeat into next year. So here we come to the inflation data, right? So basically the glaring omission is seasonally adjusted changes from preceding months in food, energy services, apparel, medical care, shelter. So basically everything you use in on a day-to-day basis, like food, clothing, shelter, and energy, they have just removed the seasonal adjustments and just they've blanked it. So there's just there's no uplift. And as you can see here, all items, I mean, we're averaging, like those things average 0.3. So we got 2.6%, expected at 3%. Expected at 3%. I mean, there alone lies probably a minimum 0.3, and then all of a sudden we're at 2.9, and it's a 0.1 beat. So we were expecting an up 0.1, and we got a down 0.5 or whatever it was. So, and as you can see here, from November to November, we've had a steady increase in inflation, and then lo and behold, Trump's guys in at the BLS. Government shutdown does screws with the numbers, and miraculously Trump gets the exact number that he needs. We are still very concerned about stagflation next year, and no matter what it shows in the numbers, if there is real stagflation in the economy, it's still going to slow, and slow heavily. And basically, all you're doing is making things worse making the inflation problem worse down the line by cutting rates and falsely inflating asset prices. So, but I think that's Trump's general philosophy is that's the next president's problem, not my problem. So as you can see here, those average changes. I mean, and then we've got things like chicken is up. Last year was $4.99, it's up 22 cents. Meat was $6.50, is up $1 over the course of the year. Beverages were $4, and they're up 25% over the year. Like, yeah, there's no way this inflation data is close to being correct. But that's the world we live in at the moment, and like I said, really all you're doing by falsely releasing data, not taking care of inflation, and bearing in mind that was the only job that central banks had prior to 2007 GFC was to monitor inflation. Now they've got, they've been given the extra responsibility to now their mandate is inflation and labour growth. And that sort of crept in, but it hasn't always been the case, but it's always been inflation. So, look, I know they've got broader problems where they need to refinance debt, et cetera, but like we've been kicking the can down the road since the GFC, and it just ain't going to work, which will be good for these guys because, look, real assets are going to keep going. US dollar is going to be horrible next year, I would expect. And silver pulled back a little bit. Platinum continued its run. I don't know whether it quite got through that 2000 level, but it was very, very it got to 1995 the last time the last time I checked in the futures. It's sitting at 1959 now, but that was the high, 1995 and 55 cents, so $4.50 from that 15-year high, up 91% for the year. I think silver is the only one that's really beating that, is up around about 95%. So for those of you who are on our gold and silver enhanced growth strategies and our silver and platinum enhanced growth strategy, happy days. So we managed to take off a third of our silver platinum enhanced growth, which was leveraged 5 or a little bit over 5 to 1. For 300% ROI on cash, and a near 60% return on the notional. I overnight, and then we've got that was a 2-year strategy which we did back in May. So we've basically got around about 17 months to go. So yeah, but and then our gold and silver, which we made 300% out of last year, we're coming into now already after which we reloaded in August. We're already up another 150 odd percent on cash. Another 30 odd percent on notional. So I think this will continue into next year, and then look, crude's looking very, very cheap overall. Like compared to how much other commodities have risen and how much inflation's around, but I think it's got other issues. We'll definitely keep an eye on it overall. Today, what we'll be looking at is just really the Bank of Japan is coming into that could move markets at some stage. I think people will scratch the surface a little bit more on the inflation data and realise that those rate cut expectations are not really going to be realistic, and we will. We'll probably have a fairly flattish day. I would, or probably a bit of a recovery in our market. I mean, the commodities will hold us back here in the SPY, but we're up about 0.5% in the SPY futures. So I would expect that. I reckon we can maybe get up to 1%, maybe today. Bit of a recovery in the other stuff, and we'll see how we go. Our market outlook is out now. You can register at that address at the bottom. We are running an enhanced growth strategy on 3 of our key themes to watch this year. You'll have to request that. And we're doing an income investment for those of you who want income in fixed coupon notes. As per usual, it'll be around about that 12% per annum mark. And if you're on any of our email lists, then you will receive an email today leading into next week. But yeah, some fairly nice prices there overall. And, our track record with 11 out of 14 predictions being correct last year and only 2 sort of being up for debate, 1 being incorrect. We thought we'd run a 12-month enhanced growth. It'll be roughly around, you'll be getting roughly around the 6 to 1 mark in terms of notional exposure for the amount of cash down. And obviously it's risk managed, so you have a capped downside as well. So, you can either email me, mark.gardner@mpcmarkets.com.au, or go to our website, but have a look at the outlook, and, you have a bit of it'll be, obviously we've done very well out of these investments so far, as you heard before, and, they're for sophisticated investors only in Australia. So, follow us at MPC Markets, Spotify, YouTube, Apple Podcasts, or go to mpcmarkets.com.au/mosaic. Get all our content, podcasts, stock picks, news, and everything all in one place and on your mobile. 1 month free trial of all of our recommendation services. So have a great day. For those of you who have the last day of work, have a great Christmas and New Year period. Thanks everyone for listening. We will be running it, the morning call up until the 24th next week. However, for those of you who aren't coming back and are going to get some time off, enjoy, and wishing you and your family all the best for Christmas. We'll speak again Monday or next year. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.